once we get through 1310, we're probably going to have enough momentum after this big move in the first quarter of this year to get to 1400. Once we get through 1400, I think we're going to have a magnet to 1450 and then all the way to 2000.
Silver investors could make a fortune. Billionaire Eric Sprott and other top gold analysts predict that silver will dramatically outperform the yellow metal. In order to maximize your exposure to silver, consider shares of Golden Arrow Resources trading on the TSX Venture under GRG and the US as GARWF, where insiders have accumulated 50% of the company, and billion-dollar giant Silver Standard Resources has taken an 8% stake in the company. This company has 250 million ounces of silver resources and is headed up by the one man who's responsible for the largest silver deposit discovery in history. Learn more at crushthestreet.com/silver100.
Hello, everyone, and welcome into crushthestreet.com. I am Kenneth Amanduri, and I'm joined with a returning guest. I haven't interviewed him in about a couple months now, so it's time. It's due. His name's Don Durrett, author of How to Invest in Gold and Silver, and it's a complete guide on how to do it with a focus on mining stocks, and it's very readable. It comes from a guy who's both a precious metals investor as well as a seasoned writer, so you get the best of both worlds. And his website is goldsilverdata.com. Don, thanks for joining me today.
Thanks for having me back, Ken.
Don, let's hit the ground running here with silver shortage. This is how you start the book off. Now, in 1945, there were 10 billion ounces of silver bullion worldwide, and today there's approximately 1.5 billion of bullion and coins. This is what you have in your book here. You have estimated that there's 100 times investment-grade gold above ground as compared to silver. Let's discuss this. Where did all of the silver bullion go?
It went into landfills. So basically, anything electronic has silver in it. It doesn't have very much, in microscopic amounts. But every iPhone that's made, every car that's built, anything that has electronics in it has silver in it. And since it's such small quantities, once it goes into those products, it's a black hole. It never comes back out. So we've seen billions of ounces of silver since the 1940s. Basically, after World War II, we started making a lot of electronics. Silver just steadily went away, if you will. So there's a lot of silver that's in non-coin, non-bullion form. For instance, we have a lot of jewelry and silverware and stuff like that. There's a lot of it. But when you're talking about investment grade, there's not that much. 1.5 million ounces. Minuscule on when you mentioned it, the amount on you take the amount of gold that's above ground, 166,000 tons, and then at $1,200. It's just so much more. There's just so much gold more above ground than silver. Like 100 to 1 difference.
So let's talk about the production demand of silver nowadays. Obviously there's a supply deficit in what we consume and what is being produced. So where is this shortage being filled?
Well, it's a really good question. So we were kind of lucky. The last few years, we actually haven't had we've had enough production to meet demand. We actually have not had a deficit for several years now. But this year, I think last year we did have a deficit, and this year we're going to have a deficit because you have more investment demand. And it's a lot of it. We don't know exactly where it's coming from, but we think it's coming from India and China. That their governments have enough extra silver to meet that, offset that demand. But right now, most of your refineries or whatever, it's basically coming right out of the ground and going right to the refineries. So there is not a lot of excess capacity or excess supply of silver above ground. So there's a very good chance that we could run into supply issues. And that's what I put in my book. That's the reason I like silver so much, is that if we hit what I consider a shortage, now what I call a shortage is when you basically try to order something and you can't get it. That's a shortage, in my opinion.
Don, you mentioned India and China, and we even have seen this with the U.S. In 1945, the U.S. government held 4 billion ounces of silver. Today, it holds none. So my question is, why are these governments offloading silver and not just allowing the market to take the price higher?
Well, in China's case, it would hurt their manufacturing base. It would hurt the manufacturers. So they're making sure that the market exists so that the manufacturers don't get hurt. That's the reason why the U.S. government sold their silver. They didn't want silver to go higher. They want the markets to work. But at a certain point, the markets are going to break down, and you're going to see silver blast off, in my opinion. I think that's what's going to happen.
One of the things that you mentioned in the book is ETF demand causing a shortage, and therefore a price spike for the metal. And could you expound a little bit on this and why ETF demands can actually send the price of silver higher?
Well, because most of these ETFs, when you buy the ETF, they actually have to buy silver on the open market and put it in their warehouses. SLV, PSLV, CEF, these are all very large ETFs that store the metal themselves in their own warehouses. And if you look at the number of ETFs that have arisen since the year 2000, we had very little silver in warehouses from ETFs in the year 2000. Today, it has steadily increased. So these ETFs are sucking up the silver off of the markets. And so, yeah, it's, like I said, it's inevitable. I think we're going to have a shortage for that reason.
Don, let's transition to gold. We did see gold break down below $1,250, and I know you mentioned it being a price point you were watching, and I wanted to get your thoughts on the significance of this breakdown, and is this correction, this trend that we're seeing with gold, is this a concerning correction or just a normal pattern of what goes on during regular bull market trends?
Yeah, I think this is just a normal correction. I mean, we've had a very big move from January all the way up to end of April. We had gold move all the way up to 1290, and then it's down to actually up to 1306. Today it's down to 1212, so it's about a 7% correction in gold. So after that big move up, seeing a 5 to 10% correction is not unusual. The key here is going to be once it finds its footing. We don't know. 1220 was a very important support level. It went through 1220 today. Once it went through 1220, it went all the way down to 1212. So I'm hoping 1200 holds. We'll see. We don't know where this correction is going to end. So we've also in the miners, we've seen the HUI drop down from 235 down to 200, which is a little more than a 10% correction. And you're going to expect things like that. We've had a 3-month run here from 100 in HUI all the way to 235. As an investor, you're hoping you don't get these big corrections so quickly. And I'm sure a lot of people are nervous. They're seeing a lot of their gains, go poof real quickly. So it's a little nerve-wracking. But the one thing that's driving this is the economy. In May, I wrote in my newsletter that I thought that the price of gold would be lower at the end of the month than it was at the beginning of the month. And that's exactly what we're seeing. We're seeing May as being a very soft month. I thought it was going to be soft. The economy, we're not seeing any bad economic numbers this week. We didn't see any bad economic numbers, basically. And the Dow, all it did was just trend up all week long. It's at 12,850 right, or 17,850 right now, and a pretty solid week. And so,
and now I know that was something you mentioned as being a potential concern for gold. Positive numbers out of positive economic numbers being a concern for gold. So. What are your thoughts, though, Don, going forward? You know, I know 1310 was a big price point for you. You know, where is gold headed as it breaks through 1310 and moves up from there? What are your thoughts on that?
Well, the key, of course, is 1310 is a very, very important support level. If we break through 1310, it looks like the gold trend reversal, the downturn we've been in for the last 5 years, is going to be over. We're not going to get confirmation until we get all the way to 1450. But once we get through 1310, we're probably going to have enough momentum after this big move in the first quarter of this year to get to 1400. Once we get through 1400, I think we're going to have a magnet to 1450 and then all the way to 2000. So the trend is looking really good for gold after we had this big move in the first quarter. Now, we've had this significant reversal in May, so June and July are going to be really important. We don't want to get stuck underneath 1300 this whole year. We got to break through 1300 this year. Once we do that, I think we break through 1310, we break through 1400. So the key is going to be the dollar index. If the dollar continues to get strong, now the dollar's at 95.6 today. I don't like it. Anything over 95 makes me nervous. The dollar, conceivably, they say they're going to raise interest rates here in June or July. If they raise the interest rates, the dollar can make a move a little higher. Who knows? It might trend up to 100. If that happens, we're going to have a lot of downward pressure on gold. I think we need to get down to dollar index down to, say, 92 before we see a breakout above 1310. Maybe 93. But I think the dollar's gonna have to weaken here for gold to break out.
Well, you got to assume that there's a lot of strong hands in the market now with all the people who've bought at these levels. And if we do see some sort of correction here, it won't be as dramatic as it's been. That's what at least I'm telling myself here, and maybe you would agree with that.
Yeah, that gives me hope. That gives me a little bit of confidence when we've seen this really strong move in the miners. But oil is basically, I think, hitting a little top here. I think we have too much inventory in oil. Oil's made a run from 26 to 48, almost a double in oil, when really the fundamentals don't support that big of a move. So oil's probably going to go down here. That's nerve-wracking to me. I think the GDP number of second quarter is going to be 2% plus. That I didn't want to see that. That's not good for gold. And the dollar, it looks like they're going to raise interest rates in June, so the dollar looks like it might go a little higher. So some serious headwinds against gold here, breaking through 1300.
Fundamental.
The other thing, or go ahead.
Don, I just wanted to pause right there because fundamentally, though, the Fed really can't. They don't have a choice. Not a good choice, at least. Keep interest rates low and keep this thing going, or raise interest rates, tighten down on monetary policy, and deal with the consequences of those actions. Both, there's economists out there that are saying either direction long term is good for gold because it's, the U.S. is headed for a crisis scenario. What are your thoughts on this?
I'm glad you're well read and you understand these things. So the more you peel back the onion, the more you see these kind of discrepancies. So the word is that they're going to try to raise rates in June, but you're right, it's not going to be easy. They're up against kind of a wall here. They raise rates, they can make the stock market drop, but simultaneously they're probably going to make the dollar rise a little bit. Because right now, I was reading where 60% of all of positive yield bonds are U.S. Treasuries. So everybody wants to own a Treasury because they're the only ones that are making any money.
Wow.
So yeah, I actually wrote my last newsletter that if they raise rates in June, the stock market would basically drop in July and August, and then they would have to basically go into quantitative easing. So if they raise rates, I think they're setting themselves up for the next QE4. So yeah, I'm agreeing with you. The fundamentals really don't support it. Carl Icahn recently went short the most that he's ever done in his life. It's unbelievable how much money Icahn went short, and I respect him. Icahn, he knows what he's doing. The reason why he's shorting the markets is because we've never seen this type of sluggishness globally. I mean, the U.S. earnings have been trending down. Europe is definitely trending down. China's down. Japan's down. So you have these earning trends that are down. The export markets are very lethargic. So why are we raising rates? It doesn't seem to make sense. I think they're raising rates. It's almost, they have these rose-colored glasses on, and they believe that the U.S. market is strong enough to raise rates. It's interesting, but I'm with you. I think it's a mistake. But if they don't raise rates, things are just going to get worse too. So they're rocking a hard place, right?
Yeah, it really is, and I enjoy listening to people like you who have, spent the time to think about these things and to anticipate. And I guess it's a short-term thinking. And maybe you would agree with this, to think that the miners are going to go down because of a rate hike or because of something that the Fed does to tighten, because again, long term this is all very bullish for precious metals, because it's that rock in a hard place, and the damage has already been done. And you can go back to 2008, the response to that, 2001, and just all the things that we've been doing as we've gotten off the gold standard here. But moving on here, Don, I want to get into your book a little bit more. It's like I said before, it's detailed, it's full of amazing data and information, and I encourage people to pick it up because it's such a consolidated resource, and really the only book that goes over how to invest and how to value junior mining companies. So if you'd like, what is the most important message that your book has for the readers, your audience?
Just all the data points that you need to look at when you invest in a miner. There's just a lot of data points. First of all, we mentioned the book. We didn't say where they can find it. So the easiest way to find my book is to go to my website, goldsilverdata.com. Go to the bottom, and there's a link that says book. Okay, so we got that out of the way. So I'll go over some of these things. But the other thing is difficult in the miners is it usually takes about 2 years to learn how to do it. I mean, 1 year and you're still learning because there's just so many data points.
There sure are, yeah.
Yeah, a lot of risk involved. I mean, right now, because the miners have been beat up and silver is low, right now, I mean, the smartest investment right now for the miners is SILJ. Because SILJ is really the only junior ETF, so it's basically junior mining companies, junior, and GDXJ is the gold side, but it's basically a mid tier. But so, I mean, a lot of times people say you can't beat the indexes, so you just buy the indexes because you're not going to be able to beat them. And SILJ is one of those stocks that's going to be really hard for my investors to beat. So if you're investing, kind of on a risk averse, you don't really want to go for the 10 baggers. You just want to have if you're looking for 3 to 5 baggers, you just can't beat that. So that, I want to mention that right off the top. So now, if you're going to invest in miners, you want to have good upside. So you really want to go after, in my opinion, if you're not going to do the ETFs and you're going to do miners, then you want to look for what I call 5+ baggers. So once you get to the 5+ baggers, then you have to start knowing what to look for, because you want to do what it's called due diligence. You want to look at all these data points. Well, I'll talk about some of these, give people some stuff in the book that helps people to understand some of this stuff. So the big three are what I call the 3 Ps. So the first one is the properties. So a lot of people they want to invest in exploration companies, but exploration companies, you're betting on geology, but it's usually for every drill hole that a geologist says to drill, it's like 1 in 500 will be a mine. So a lot of people will invest in these exploration companies before they've actually found the goods. So it's just I call that chasing drill jobs, or going after exploration companies. It's okay. Sometimes it's okay to do that on some kind of companies, but realize that about 1 in 10, or you go after exploration companies, 1 in 10 will be successful. So 9 in 10 are going to break your heart. So I usually avoid exploration companies, so that's right off the top. So when you're looking at properties, I'm looking at flagship properties that have already found mines, so what I call flagship properties. So if you go after companies that have flagship properties, And then there's all these other data points you have to learn about, like, what is the life of the mine? What is the recovery rates? What is the grade? Do they own it 100%? The location. Is it in a good location that has a lot of risk? You start learning about, what the properties provide. So that's the first thing. You have to understand what you're looking at. And then the next one is people. And people, a lot of times, you need to find out from someone else if they know about these companies. So it could, join my website, go on the forum, and say, okay, does anybody know about this management team? Are they any good or not? Because management teams will also break your heart because they don't execute well. What are their past successes? A lot of times these management teams are not investor friendly. They do a lot of dilution, so you have to find out how shareholder focused are they. So people is very, very important.
Absolutely. No, I couldn't agree with you more. Really interesting stuff there. There was one more P, right?
Yeah. The last one is projects. So basically, after the property will turn into a project, so once the property they start developing it, then you have to start looking at, what is the how many what's the production going to be on that project? What are the resources? How many are there? So there's certain levels. What's the capex going to be? So it has the high capex projects. I usually tend to avoid because they're really, really difficult to finance today. So investors kind of stay away from them. So I like to look kind of this sweet spot. I like to find companies that are market caps between 25 million and 150 million, and then they're building their first project, and the capex is somewhere around 100 million. So they're not building a real large project. You can go up to 200, but 50 to 200 million is kind of the same size as the market cap. So you find these projects that they can finance them, and then the IRR, the return on that particular project, is really important. So you want to stay away from anything that has after-tax below 25%. You can go down under 20, but the risk starts to increase. But investors really like, if you have an after-tax IRR at 25% or higher, that's a pretty good project. And then the financing, what's it cost? How much? Then also on the project, what are the cash costs? That's really important. So you want the economics of the projects. So that's the other piece. So.
Don, in the 1980s, gold went from like 300 to 800, and there was like the bull market started before that, but that's kind of when the euphoria happened, that 300 to 800 run, and I know you outlined that in your book. And what I'm talking about and what I want to ask you about is the junior miners and people getting in at a certain point where there's risk when it collapses. People getting in that euphoric stage, maybe when gold is getting to its peak there, and now it collapses. I'm wondering, with the move that we have seen in the miners so far, do you think that after we see the bull market peak and then the collapse, will the collapse still be above where we are today? Meaning essentially like a risk-free scenario over the longer term, or are we likely in that middle range here where, miners are going to go up, in that bull market range, but then collapse lower when the whole thing is over?
We're still way, way below where it's going to when it does collapse. I think we're below it. So we're still in safe territory. I think $18 silver. I always thought that anything below $18 silver is basically the safe range. Once we get above, so the HUI right now is about 210. It was at 600 back in 2011. It's probably going to go to 1,000. So we're down at 210, and it's going to go to 1,000. So when it does crash from 1,000 down, it's probably going to land somewhere, in 300. So I think we're below that area. It's a good question. So for me, we're real early in the game because I think that, if you look at the situation of the global economies, gold is going to, at some point, it's going to blast off, in my opinion. When it does blast off, the miners are going to blast off with it. So for me, I look at what is your exit strategy. For me, I think the minimum price of where gold's going is back to a new high, which is 2,000. But I think conservatively 2,500. My conservative estimate for a gold price is 2,500. So my exit strategy is basically I'm not selling until we get $2,000 gold because I think that's inevitable. And then as we go from 2,000, as we continue up the ladder, 2,100, 2,200, that I'll start exiting more and more as we go up. By the time, some people will probably ride this thing, who knows, all the way up to $5,000 gold. But by the time we get to $3,000 gold, I'll probably be 75% out of the market.
Yeah. Don, would you be taking into consider the length of time this takes? If it's 4 years from now and we're at $2,000 gold, is that going to be a signal that this bull market might be over simply because it's been 4 or 5 years?
Yeah, that's a good point. I think that the price of gold rising will go straight in tandem with your global economic macro situation. So the only thing that's going to make gold basically come to an end, the gold bull market come to an end, is your economies coming back to life. So that's the thing to look for. My biggest fear has always been growth. That's why I talk about the 2% GDP number in the second quarter. I'm nervous about it. I'm nervous about the dollar going up. So it's going to be global economic macro. So as we go up to $1,500, $1,600, $1,700 gold, when that happens, that'll come from economies weakening and the fear trade increasing. And so as you invest, you'll be seeing more and more people go into gold because of this, because of the fear trade increasing. So the thing to look for, the ultimate exit point, is when gold and the Dow are basically 1-to-1. So back in 1980, early 81, they were both at 800s. There was 1-to-1. I think it was 850, 850, something like that, 1-to-1. So the next time, 1-to-1s are the ultimate exit point. Personally, I'm going to exit at 2-to-1. I'm not going to be greedy and wait all the way till it goes 1-to-1, such as 5,000, 5,000, which is about what I think it's going to do. We're probably going to see 5,000, 5,000.
Wow.
But I'll probably get out somewhere around 7,000, 3,500.
That's big. That means big moves for the Dow Jones and the markets here, considering where they're at today. Don, talking about the gold to silver ratio, historically we've seen much lower ratios than we've seen today. Is there a reason why gold continues is growing, is getting distancing itself from silver in today's time as opposed to the 1900s and then where it was prior to 1900, even lower? I mean, what was 1900? Like around 50?
Yeah.
And then, prior to 1900, it was around 16, and, we're looking around 75 today, something like that. So is there a reason why it continues to distance itself here, and is that going to be the new norm, or are we going to go back to some sort of historical average at one of these days?
Well, this one's actually pretty easy to get a handle on. All you have to do is go back to 2008. It was up at 70. I think it may be higher than that. And once we had the breakout in gold and silver, silver outperformed gold significantly, and we got down into the 30s. In 2011, you had when silver was at 50. I think it went to 49. So if you do 49 versus 1972, that's probably what we were at. It's about 50, I think.
Yeah.
So you're going to see the same thing happen when we get the breakout. You're going to see silver outperform gold. So I already know that basically that 70, 75, 80 is just completely disconnected with reality. Like what we talked about earlier about there's less silver. Bullion. I mean, if you look at the amount of money, the investment money that you can put in silver versus gold, there's very little silver you can buy. It's unbelievably how little silver there is above ground in supply versus 166,000 tons of gold. So we're going to see the ratio shrink. Economics demand it once people want it. So what the question is, we know it's going to shrink. The question is how much. So I think if you say it's going to shrink by 2, which would go from 70 to 35 or 80 to 40, I think that's inevitable. I mean, it's just a matter of how much more it shrinks. Now, I personally think that 30 is definitely going to be in the cards. It's very possible that it'll go to 20. And some people think that if silver actually has more utility than gold, so if we get to the point where we literally have these silver shortages, and people can't make their iPhones because they can't find any silver, who knows? It could go 1-to-1. I mean, that would shock me completely. But I think that 20-to-1 is something. I think that's a good expectation. So buying silver right now. So I mentioned SILJ earlier is probably the ultimate mining index right now, the ultimate mining investment on a risk-reward basis. But the other thing that's fantastic to buy right now is silver bullion under $18. The one negative about silver bullion is you have to pay a higher tax. It's a 28% investment tax. They call it I forget the actual terminology. It's when you collect. It's a collector's tax. That's what they call it. It's 28%. So that's the ugly thing about buying silver. You have to pay a higher tax.
Don, so I got to ask you about what happens when we do see this gap close down. What's going to be going through your head? Jump into gold at that point? Maybe think of some other investments, or maybe that will be the peak of the precious metals run there.
You're covering some great. I have to interrupt. You're covering some great questions. Absolutely. When we see silver basically go all the way down to 20-to-1, at that point you want to go into gold, because gold is a safer investment. And the reason why it's a safer investment is because of the SLV ETF. And that's number one, because they can always just release that. There's 350 million ounces of silver in that warehouse. The government could basically say, we're no longer going to allow silver ETFs. We're going to outlaw them, and all that silver has to be sold into the market because the manufacturers can't find any silver. So silver has a much higher risk level. So go into gold, definitely. So that's a really good question. The other risk about silver is that if we have a global depression, 80% of silver that comes out of the ground every year, 800 million ounces, 80% of that goes directly to manufacturing. So if we had a global depression, you could have a glut of silver.
Well, that is very much a concern for people, because if we're planning on a global crisis here, which I know a lot of people are, how big of a threat is that? Will the surge in demand in the investment demand outperform the industrial collapse? Right.
So this is how I'm looking at it. So silver is basically a 2 times, 3 times leverage to gold right now because of this ratio. So what I plan to do is I plan to start exiting out of my silver positions at $75 silver. So every $25, I'll get out more. So 75, 100, 125, 150. So by the time we get to 150 silver, I'll be out of most of my silver investments because of this risk level. But I'll keep my gold investments because they have much less risk. But right now, it's 2 times, 3 times leverage. You got to ride it. So it's like there's a lot of risk, but there's a lot of reward in silver. But that SILJ, I think that's going to easily be a 5-bagger in my opinion, just because of the leverage.
Yeah. Everyone, this is Don Durrett, author of How to Invest in Gold and Silver. If you liked the conversation we had today, definitely check out his website, goldsilverdata.com. Don, if there's anything else that you'd like to add here about either your website or your book, or just any other closing thoughts, please share with us. Again, thank you so much for coming on the show. It was such a course. You put me through a course here, and I know the audience really appreciated the information you shared with us. So please, any final thoughts or comments?
Well, I would just say that if anybody is interested in investing in gold and silver, definitely buy my book. It's not that expensive. It's basically a textbook. It's 300 odd pages, and it's a large book. And I've updated it every year, and so you're going to learn a lot in that book, and then you can decide which way you want to go. If you're going to invest in any mining stock, definitely need to read the book first. Then you can come over to the website.
Thanks, Don, for coming on the show with me. I do appreciate it.
Great questions, Ken. Enjoyed it.